Welcome to the Academic's Guide for Retirement Investing. My name is Dr. Phoenix Singh, and I want to welcome you to this episode of Navigating Academia. What's up, everybody? Welcome to this special episode of Navigating Academia with me, Dr. Phoenix Singh. I want to warmly welcome you here to the episode where we're going to be discussing some simple principles I want you to know about when it comes to retirement investing. Now, you guys know I appreciate the love, so please, before we get started, help our channel out by just hitting the like button, subscribe to the channel. You can also share the link on social media, or you can follow us at these social media accounts. In addition to that, please do feel free to share it via direct link with your friends, with your colleagues, and with your students. So let's jump right into it. Being an academic is difficult. We're not the individuals who are going to be making $500,000 a year. It's just not going to happen. The average salary these days for academics is, usually upper 70s, right, across fields. This is $70,000-ish, upper 70s. And it is obviously true that if you're in some areas, let's say you're teaching for a law school, teaching for a business school, for a medical school, this can be really significantly higher than, let's say, you're teaching some liberal arts subject at a university, a very small university, let's say. But what I have to say here today is that if we start planning for the long term, we can be more than set for retirement. Especially, I'm a millennial, right? And whether you're Gen Z, millennial, whether you're a Gen Xer, baby boomer, whatever it is, it really stands to reason that you should always be saving, as much as possible to be able to put into a variety of different investment accounts to be able to plan for your future. I think it's really important. I think people don't do it enough. I think that there is this falsehood that's going around that people should not save anything, but rather spend all their money on experiences because we're young and let's be young and da-da-da-da-da. And then all of a sudden, we all know what's going to happen, right? People just don't think about it. You're not going to be able to retire at the same standard you'd be able to otherwise. Some other people would say, yes, but then you've never truly lived. And I totally understand that it has to be a balance between these two. So don't think that I'm just some stingy guy. I'm just trying to let you know what I would recommend. Okay? So what I want to do is to make 5 key points here today about 5 different security vehicles, as they call them. So for every dollar that you end up getting, my recommendation is to be able to save between 10 to 20% of it. So in that case, 10 to 20 cents. Obviously, if you are an academic and working in a university setting, you may have the benefit of the first thing I want to talk to you about, which is a 401k. So a 401k is a specific kind of retirement account which you always need to max out. Just trust me on this. You will never have any investment which provides you with the same benefit as a 401k. The idea behind it is basically you'll put in a specific amount of money because there's a cap. You can't put in more than a specific amount usually, right? And your whoever you work for, so in this case your university, right? They will match the contribution up to a specific amount. That's like ridiculous. That just does not happen in any other kind of investing. Stocks, bonds, real estate, whatever. I don't care, right? 401k is the best, right? And as they say, set it and forget it. Put it in there, forget it, right? Just pretend that the money basically doesn't exist for as long as you can until retirement. And then you can actually start taking it out. But max it out every year. People usually say, well, I could get something right now, or I could put it in there and not touch it for 40 years. Trust me, I get it. It's like that marshmallow test in psychology where it's like, you can have 1 marshmallow now, or if you wait a while, you can have 2 marshmallows. And people are like, screw that. They're going to eat the marshmallow now. They don't want to wait. Especially when you're young, I completely understand that, right? But the more you can put in, the better. And a lot of people don't understand 401ks. So all you need to know is that it's a specific, really great kind of retirement savings account that your employer will have set up for you. And all I want you to do is to put in as much as you can every year that they will match. Sometimes you can put more in, but they're not going to match anything. In that case, don't worry about it. You can invest that money better somewhere else, right? But max out whatever you can that they will actually end up matching a proportion of, or even all of it, depending on who your employer is. That's a 401k. Okay, the next thing that I want you to know about is something that you'll hear about all the time these days because they're really hot. They're called ETFs, right? And an ETF is just an acronym for an exchange traded fund. So here's the thing, right? You've got ETFs and mutual funds. The idea here is that let's say you really love technology, okay? And you really love Apple products. Like I love my iPhone, right? My iWatch, as you can tell, right? So I'm an Apple guy. So obviously I could invest in Apple, just Apple. But the thing is that literally like last year, Apple stock dropped like 40%. And it actually did. And I mean, scared the bejesus out of me because I had all this money in Apple stock, right? Now, the smarter thing would be to say, I like tech stock. So what I want is a little bit of Apple, a little bit of Amazon, a little bit of all of these different tech companies, a little bit of Facebook, a little bit of, Tesla, a little bit of all these different things, right? And then all of them together, if one of them plummets, the rest of them keep it pretty high, right? If one of them skyrockets, of course, then everything else won't skyrocket, but everything will go up a little bit, right? But you're basically hedging your bets. That's what you're doing, right? And over time, if you believe in the sector, if you believe in the strength of technology, obviously over time it's gonna go up. And that's what you see with technology over time, is that the whole field of technology or whatever keeps progressing and becoming more valuable. In other words, the investment you make will also be earning more money. So here's the thing, right? Like I said, you got ETFs and mutual funds. A mutual fund, there's an actual person or firm who every day, every month, they're looking at that basket of stocks, a little bit of Apple, a little bit of Amazon, a little bit of Facebook, etc. And they're selling a little bit and buying a little bit of this one. Sell a little bit of this, buy a little bit of this. They're being really active, okay? Now here's the problem. Usually every time that you buy or sell something, you have to pay commission to a brokerage house, something like Fidelity, for example, right? A brokerage house just means that it's not really a bank, kind of like a bank, but basically it lets you, have an account and trade stocks and bonds and these sorts of things from there, right? So every time that you buy or sell something, you got to pay a fee. Sometimes the fee can be like $5. So if they keep buying, selling, you're the one who has to pay $5, $5 over and over again, right? In addition, they could charge something called a load. And a load is basically every time that they sell something, right, they get a little bit of money. And of course, that would mean that they're gonna wanna buy and sell as much as possible to be able to get their load, okay? And so obviously, that's not ideal. And at the end of the day, most of these mutual funds, they don't end up outperforming ETFs anyway. And you have to pay a percentage, usually, right, to the mutual fund firm every year for essentially doing all of this, just going through and being really active, okay? Now, some people like mutual funds because they like the concept of somebody else managing their money really proactively, right? But the thing is that in the overwhelming preponderance of cases, they don't do any better than exchange-traded funds, than ETFs. So an ETF is, again, it's a basket, just like mutual funds. But the difference is that usually about once a year, right, they'll change the composition of the basket. And that's it. There's no load or anything like this. There's no, fees for, buying, selling, and these things every week, every month, etc. No. Essentially, it is just one fee that you're paying. And the fee that you're paying is what's referred to as the net expense ratio, or the NER. If you take a look, if you just Google a stock and all, or excuse me, not a stock, if you Google an ETF, you'll usually see something that either says NER, net expense ratio, or just expense ratio. And that's all that is really, okay? And the good thing about ETFs as well is that usually they'll have something called a dividend, right? Which usually will be called something like yield, for example. And this is basically to be able to thank you, to be able to put money into the ETF. The ETF managers will just give you some percentage of interest back. So let's say, for example, that you invest in an ETF and the dividend is 2%, so the yield is 2%, and you put $100 in, okay? So what would happen is that every single year, regardless of whether that thing goes up, down, doesn't matter, you're still gonna get $2 a year. Okay, that's the idea. And over time, sometimes these funds increase their dividends as well, which is great. So you're just gonna get more money over time. But here's the thing, right, is that you still have to subtract from that the net expense ratio. right? So that's what you have to keep in mind. So even though it says 2%, if the net expense ratio is 0.5%, you have to take that into consideration. So it's not exactly 2% no matter what, because you got to pay that net expense ratio every year as well. But they kind of balance out, as you can see. All right. So really, ETFs are great. They're a way to hedge your bets. Somebody else is kind of managing stuff for you. Avoid the mutual funds for the reasons that I said, and I want you also to really just avoid individual stocks as well, unless you're really monitoring it. Just don't. Just use ETFs in different sectors that you believe in. And these could be sectors like, technology. These could be sectors like finance, energy. There's so many different ETFs. Literally, tens, maybe hundreds of thousands of these things. There's just so many of them because people make a lot of money off the net expense ratios. That's how they're making money, right? But at the end of the day, they're the set it and forget it thing that you want, just like for the 401k. My goal for you is to not have to worry about this to the extent possible. And when in doubt, the best ETF it's called SPY. Right? SPY is just the S&P 500. S&P 500 in America is the 500 best companies, the most liquid companies, the companies that essentially are performing the best. It's a mix between growth stocks that are, growing really fast and have a lot of potential, and value stocks like the blue chip ones like McDonald's and Costco and Walmart and these different ones. So you have really broad exposure. 500 of the best companies in the United States. You get a piece of all of them, and you end up getting a dividend. Just invest in SPY. When in doubt, SPY. The majority of hedge fund managers and these guys and mutual funds, they do not beat the SPY, and they certainly don't do it consistently, okay? So just invest in SPY and then just don't worry about it. That's the easiest way to be able to do this, guys, okay? So that's number 2. So the third to be able to talk about is what's called a money market fund, right? You don't want your money in cash. Cash ain't gonna do anything for you, okay? If anything, because of inflation, if you have $100 this year and you got 2% inflation, the next year you're gonna have $98 if you just save it and don't, do anything with it, right? And the next year you're gonna have even less, even less, even less. And it's literally just going to eat away at what you have. So you gotta put it somewhere. If you have a good amount of savings, a good place to be able to put it is into something called a money market fund, which is not really a CD, right? CD basically is the bank. Basically, you're loaning the money to the bank for a certain period of time. That's not really what you're doing with a money market fund. It's much more liquid. If you need to pull the money at any time, you could, and that's what we call liquidity. Illiquid is something like a 10-year bond where you put the money or whatever into, let's say, the municipality that you're in. It's a muni bond, a municipal bond, and it's locked up for 10 years. You can't touch it. And if you take it out, you get penalized. That sucks. Don't do that, right? Instead, what you want to do is you want to take that money and you want to put it into something like a money market fund where you can still take it out and you're not going to get in trouble, but it's actually going to be paying you some interest that, if nothing else, it's going to match inflation, okay? So this way, if you just want to keep everything in cash, maybe you're waiting for the market to go down so that you can put some money into some ETFs, fantastic, right? But outside of that, never keep money in just like total cash. Money market funds, some people use the acronym MMF, is the way to go. Ask your bank about it, ask your brokerage house about it. You can call them up and say, what is the highest yielding, right? So the highest interest, right? What is the highest yielding money market fund that I can put my money into right now? Boom, fantastic. Fourth thing I want to talk about is what's called a REIT, and a REIT is a real estate investment trust, okay? Now, here's the thing with a REIT, okay? REITs are basically for people who are lazy like myself in terms of real estate, okay? I have a lot of friends who they've gotten their real estate license, they go out, they're buying places, they're renovating them, they're flipping them, God bless them, I think it's fantastic, right? However, I don't have time to be able to do that, but I still want to diversify my portfolio to make sure that I'm not just in stocks, ETFs, these things, I also want to be in real estate. The easiest way to be able to do that, guys, is through the use of a REIT. The good thing about REITs is that there's different kinds. There's hotel REITs, and hotel REITs usually, your interest on them, right, the return is really quite high relative to things like multifamily REITs, condo REITs, etc. You've got REITs that cover all of these, and you've got REITs that are really specific to each one of those different kinds of properties. And depending on how the real estate market is doing, interest rates, etc., I can tell you right now that this can really fluctuate quite a bit, but it's still a good thing to be able to have as part of your portfolio in addition to all of these other types of securities that we've been talking about. So if you're interested in getting into real estate, but you don't want to actually go out there and, do, HGTV TV show type stuff with flipping houses, just invest in a REIT. There are so many REITs. Like with anything, you're going to want to do your background research to find the one that's right for you. Maybe talk with the financial planner, but then at the end of the day, invest. And I can definitely recommend it because you can get some pretty amazing returns. The stock market in general, right? So like SPY, over an average of about 20 years, you're going to get about 8% a year. But remember, if you don't touch that money, it's just going to continuously compound, which is amazing. And compounding and dividends are the things that are going to end up making you the most money over time, basically, if you just set it and forget it. Invest the money and then don't worry about it, okay? A quick tax thing in the United States is that if I invest money in SPY and then I take it out next month, let's say that the market goes up by 10%, right? And I invested $10 and all of a sudden, oh my gosh, I've got $11. I sell it and I say, yes, I've made $1. I got to pay taxes on that dollar. Not the 10 I put in, obviously, but that $1, I got to pay taxes on that, okay? So here's the thing. Right, I'm going to have to pay taxes just like it was ordinary income. Just like from the university paid me $1, whatever that rate is, that tax rate is, I gotta pay the same thing. But if I keep it in right now, the way the law is in late 2019, if you end up having a stock that you have held, an ETF included, for more than 1 year, then you get taxed at a significantly lower rate, which is called a capital gains tax rate. So what you could do is type in the current year and capital gains rate, and you're going to be able to take a look at what that is, right? So if you sell after a year, it really gives you a lot of motivation to hold on to a stock for a minimum of a year because your tax rate is going to be so significantly lower, which is awesome, okay? Dividends though, no matter what, the dividend, I mean, there's different kinds of dividends, but most of them are going to be ordinary income dividend. So your dividend that you end up making, that yield, that's going to get taxed just like it's ordinary income in most cases, right? There are some things that are beyond the scope of this video to talk about, but anyway, so that's that. And the final point that I want to make is just a word of caution, right? So again, I really recommend avoiding cash, right? Just if you have assets, allocate them somewhere. You got to deploy your capital, okay, if you want to make money. Warren Buffett, who's this famous American investor, talks about how basically unless you can learn to make money while you sleep, you're going to work every day for the rest of your life. So it's all about passive revenue streams. That's what you're trying to build here. The sooner you can start saving and deploying the capital, the more that money is going to be working for you, not only now, but compounding into the future. This is why it's so important to start early. And if there's that idea of, I could go and stay in the 5-star hotel or the 4-star hotel, stay in the 4-star hotel, okay? And just take that money and invest it, the remaining money. Okay, it's just a good decision for the future. Yes, I get it. There's really this cultural zeitgeist right now of, everybody live your best life, don't think about the future, and these sorts of things. Please trust me on this one. I really only want the best for you, right? I'm not saying don't enjoy life. I really want you to. But I want you to also be responsible for yourself, for your future family. I think it's just very, very important, okay? So, no cash, mutual funds, not worth it. Bonds, right now, bonds are like barely worth anything. I just wouldn't, unless you want to be actively trading on bond markets, which is beyond the scope of this video, just don't invest in bonds, okay? And yeah, there's all kinds of different bonds in these things, and junk bonds, high yield bonds as they call them. I wouldn't worry about it. Keep it simple, right? If you got cash, put it into a money market fund. If you want to allocate the money, put them in ETFs or REITs and max out your 401k. Boom, that's it. Avoid individual stocks. There you go. That is my guide for you as an academic. And do it as quickly as possible. Start today with whatever the paycheck is that you have right now. All right, everybody, thank you so much for stopping by and watching this special episode. I want to hear from you in the comments below in terms of what strategies you have followed that have been very successful for you. If you want to chat more about this, I am not a certified financial planner. I am not an accountant or anything like this. I'm just a guy who was totally financially illiterate and then essentially taught himself this kind of stuff, figured out what actually makes practical sense to academics, and I'm trying to share that information with you. So, disclaimer. In any case, please do like this this video, share it with your friends, colleagues, and students, and you can, of course, contact me via the website below to be able to schedule a one-on-one session. All right, everybody, thank you so much for watching. Don't forget to get out there, take chances, and be your best self. Thank you so much for stopping by, everyone. It's a pleasure to have you here as always. If you enjoyed this video and you'd like to see more in this series on navigating academia, please click on one of these links over here to be able to view more original content. I hope to see you there.